In a dramatic escalation of trade tensions, U.S. President Donald Trump has backed a controversial bill that could authorize import duties of up to 500% on countries importing Russian petroleum products, a move that could disproportionately affect India and China. The legislation, known as the Sanctioning Russia Act of 2025, received Trump's nod this week and has quickly sparked global market jitters. Drafted by Republican Senator Lindsey Graham with bipartisan congressional support, the bill aims to penalize nations that continue to purchase discounted Russian oil amid Moscow's ongoing war with Ukraine. According to U.S. lawmakers, pricing Russian petroleum cheaply fuels Putin's war machine, and extreme tariffs are intended to coerce a shift away from these energy ties. Under the law, the president would have the authority, not an obligation, to impose tariffs reaching 500% on targeted goods from offending countries. While this figure is technically a ceiling and not an immediate forecast, its sheer scale has triggered fear in markets worldwide. India's main stock indices logged their sharpest declines in months, with energy and industrial sectors particularly hit by renewed tariff jitters. Among countries likely in the crosshairs are India, China, and Brazil, all major buyers of Russian crude and petroleum products. Although previous U.S. tariff hikes had already seen India's duty on U.S. imports rise to around 50%, the Senate bill expands executive power to far higher punitive levels. Beyond South and East Asia, the European Union has also expressed concern that the measure could inadvertently affect its own energy trade, particularly with member states that still rely on some Russian energy imports, despite official opposition to Moscow's aggression. Officials in New Delhi and Beijing have remained cautious in their initial response, underscoring that their Russian oil purchases are driven by market economics and energy security needs. India's government has repeatedly described earlier U.S. tariffs as unfair, unjustified, and unreasonable, while preparing a host of diplomatic and legal options to protect national interests. At the same time, diplomatic ties between India and the United States have been under strain for months. A long-anticipated bilateral trade agreement aimed to boosting bilateral commerce toward a $500 billion target by 2030 has reportedly stalled, with U.S. officials blaming diplomatic missteps and India's reluctance to immediately finalize discussions with Trump's team. As lawmakers prepare to debate and potentially vote on the bill, global investors are bracing for significant repercussions, from supply chain disruptions and inflationary pressures to strategic realignments in energy markets and geopolitical alliances. Trade tensions between the U.S., India, and China did not emerge overnight. They are the culmination of years of economic competition, policy disputes, and geopolitical rivalry. Although recent headlines focus on a potential 500% tariff, much has already unfolded in the wider dispute over energy imports and trade imbalances. When Trump assumed the presidency for a second term, one of his top policy priorities was to reduce what U.S. officials described as unfair trade practices by major economies. Early in 2025, the administration began imposing reciprocal tariffs, matching or exceeding what foreign countries charged on U.S. goods, on select trade partners, including India and China, to address the chronic U.S. trade deficit. India's exports to the United States have been significantly affected by these measures. A trade think tank's analysis showed that Indian exports plunged by 37.5% in a 5-month period due to escalating tariff barriers, peaking at 50% duties on major product categories such as textiles, gems, and marine products. The impact rippled across labor-intensive sectors that rely heavily on U.S. buyers. China, on the other hand, has faced its own tit-for-tat tariff battles with the U.S., with average duties on a broad range of goods having reached triple-digit levels before talks aimed at rolling some back were proposed. Although previous rounds included tariffs exceeding 100% on certain Chinese imports, China responded by retaliating with its own duties and export restrictions on key American goods. The Russia connection added a fresh layer to the dispute. U.S. lawmakers, frustrated by continued Russian energy revenues amid global sanctions, began targeting secondary buyers of these imports, notably India and China, as part of a broader attempt to cut off financial support for Moscow. This strategy differs from traditional sanctions that directly target a single country. Instead, it penalizes global partners whose trade indirectly benefits a sanctioned nation. Critics argue this approach ties trade policy to foreign policy objectives, blurring lines between economic engagement and geopolitical coercion. Supporters, however, maintain that without drastic measures, Russia's war machinery would remain financially viable, making such tactics necessary. In India, tensions escalated when New Delhi did not call President Trump to finalize a broader trade deal, something U.S. officials later cited as a factor slowing negotiations. The absence of a landing point for a new trade framework has exacerbated mistrust, complicating efforts to reconcile economic cooperation with political differences around energy policy and alignment on global security issues. Understanding this background helps explain why both India and China are now bracing for potentially the most severe tariff penalties in modern trade history, and why global markets and policymakers are watching closely. The fallout from the potential imposition of 500% tariffs has triggered stark reactions across capitals, economic forums, and international diplomatic channels. The move is seen not just as an economic tool, but as a geopolitical statement. New Delhi has condemned the rising tariffs as discriminatory and unjustified, emphasizing that its energy decisions are driven by market realities and energy security for a population of 1.4 billion. Officials argue that penalizing India for importing Russian oil legally and at market prices undermines sovereign policy choices and sets a dangerous precedent in global trade. India has made overtures to protect its exporters and strategic industries, with government bodies engaging enterprises to assess the impact and formulate mitigation strategies. Indian industries have pressed the government to diversify markets, seek exemptions, or explore dispute mechanisms through the World Trade Organization, WTO. Experts in India have highlighted the broader implications. Tariffs of such scale could have deep repercussions on export-oriented sectors and employment, forcing India to pivot to alternative markets and partnerships less vulnerable to U.S. policy shifts. Businesses are also urging New Delhi to accelerate trade negotiations with other partners and explore trade deals that can counterbalance losses. Economic voices, including prominent bankers, have commented that this situation reflects the U.S. leveraging absolute economic power, a development that was predicted by some analysts as early as 2024. Beijing has rejected U.S. pressure as economic coercion and unilateral bullying. Chinese officials have framed any tariff threat, especially one tied to Russian energy purchases, as illegitimate and inconsistent with international trade norms. China's Ministry of Commerce has vowed to employ all necessary countermeasures to defend its interests if extreme tariffs are applied. Beijing's response underscores a broader strategic posture. Beijing is less dependent on the U.S. market than India for its exports, and it maintains substantial trade linkages with Europe, Southeast Asia, and Africa. Analysts believe this gives China more room to maneuver in the event of punitive tariffs. Beyond India and China, the European Union has quietly raised concerns about the ramifications of targeting secondary energy importers. Some EU member states, still reliant on Russian hydrocarbons due to past energy ties, could find themselves unintentionally ensnared in the new tariff net, complicating transatlantic unity on both energy and foreign policy fronts. International trade watchdogs argue that levying such high tariffs could violate WTO principles and trigger a wave of retaliatory measures, dragging the global economy into a broader trade war. Diplomats and economists alike are warning that such punitive measures could undermine the rules-based trading system that has governed international commerce for decades. The possibility of tariffs as high as 500% has already rippled through global financial markets. Financial markets reacted sharply to the news. Stock indices in India slumped, with energy and export-sensitive sectors leading declines. Increased risk aversion was seen across Asian markets as investors recalibrated expectations for global trade flows and corporate earnings. In India, analysts note that even the current 50% tariff regime has severely dented exports, with trade data showing double-digit declines across key sectors such as textiles, gems, jewelry, and marine products. Tariffs on high-growth categories have eroded India's competitive edge relative to peers like Vietnam and Bangladesh. If implemented, tariffs of 500% would likely catalyze structural shifts in global trade, reorientation of supply chains away from U.S. markets as companies seek tariff-free destinations for exports, acceleration of regional trade blocs such as the Regional Comprehensive Economic Partnership, RCEP, in Asia, and emerging alliances linking Africa, the Middle East, and Europe. Inflationary pressures in global markets as costs for tariffs are passed on to consumers and producers. Energy market disruption, with Russia potentially seeking alternative buyers willing to absorb more of its crude at discounted prices, undermining the effectiveness of sanction regimes. Economists warn that punitive tariffs could backfire by driving targeted nations deeper into alternative partnerships. For example, India and China might strengthen trade ties with each other or with other emerging markets, reducing reliance on the U.S. economy. This outcome could dilute the effectiveness of such tariffs as tools of diplomatic pressure. The road ahead remains uncertain. Congress is expected to debate the bill in coming weeks, but strong opposition from global trade partners and even some U.S. industry groups may temper its final form. Diplomatic efforts are underway behind the scenes as trade negotiators from India, China, and the U.S. seek compromises that can avert a full-blown tariff crisis. For India, the immediate task will be to stabilize export sectors and shield vulnerable industries, while concurrently deepening alliances with trade partners outside the U.S. For China, the focus will be on protecting export markets and retaliating in a way that minimizes losses. In the broader geopolitical arena, this episode underscores how economic policy is increasingly weaponized for strategic ends, a trend that could redefine international relations and global trade architecture for years to come.